So I'm here today to talk about Gasb statement, mostly about 75. I'm going to try to whip really quickly through the provisions of Statement 75. I have to learn how to talk after lunch, and talk about, really focus on what you as the employer need to know, and not really very much about the actuarial calculations. And then at the end, we're going to go through the CCMA white paper where it gives you a sample financial statement note and talk about all the interesting things you need to know, particularly if you're trying to copy that as a basis for your own reporting. And then we have a little case study where we practice finding those numbers in a different actuary's report. Okay, so I'm going to get started. And please feel free to interrupt me with questions as we go along, because for me, it's really boring to just sit here and talk to you for an hour. So if you guys ask me questions, it's better. Okay, so I'm actually going to start with 74. 74 is the statement that replaces Gasb Statement 43. It's about plan reporting. It was effective for most people last June 30th of 2017, so that if it applied to you, probably you already reported under it. If for some reason you didn't, you would most likely start this year. It's plan reporting, so it's only for funded plans. It adds some note disclosures. Everything it adds is very, very similar to what you already need to report for 75, with the exception that it asks about the money-weighted investment return. So either you're already doing this and you know you have to do it. If you have to do it this year, there's really nothing added that you wouldn't be doing anyways for 75. Okay, we're done with that one. Gasb Statement 75 is a much more interesting statement that's first effective, again, for most people this June 30th. It replaces Statement 45, so it's employer reporting about OPEB pension plans. And the two important things: just about everybody is going to have a net OPEB liability added to their balance sheets. And even though there's a lot of focus on funded plans, the statement itself does not require you to fund your plan and does not require you to make cash contributions. It's just all about reporting. Okay. So first, want to do a little review. What are OPEB benefits? These are things that are paid after retirement, most commonly healthcare. So if you provide any sort of healthcare benefits or access to healthcare for your retirees, that's an OPEB benefit. Sometimes we see dental, vision, and hearing benefits. Sometimes we see Medicare Part B premiums reimbursed. Sometimes there's life insurance. If there's life insurance inside a pension plan, like CalPERS provides some minimal amount of life insurance, that does not count as OPEB. It's only life insurance outside a pension plan. It can also be long-term disability and long-term care, again, if they're not part of a pension plan. What's never included as OPEB is what they call termination payouts. These are sort of lump sum amounts of money that get paid to people who leave employment, like cashing out vacation and sick leave. So those never count. Okay. So I said the net OPEB liability is added to the balance sheet. Very similar to pensions, we calculate the total OPEB liability, subtract out the assets, and we get the net pension liability. I think what will be surprising to a lot of people is that it is not unusual, well, it's unusual but not unexpected to find net OPEB liabilities being bigger than net pension liabilities. Pension liabilities have been funded for a long time. You know, you kind of don't have an option. You have to pay CalPERS. But on the OPEB side, a lot of people have not been funding their plans. And if they pay fairly generous benefits, for example, they pay the full premium to the retirees and the spouse, and maybe they have dental and vision on top of it, you can definitely get a net OPEB liability that's bigger than the net pension liability. So that could be surprising. We have OPEB expense, again, similar to the pension side. The big change is that the net is that expense is no longer the amount you contribute or the amount of benefits you pay. It's really calculated as the change in the net OPEB liability from the beginning of the year to the end of the year. So if you start with thinking about that change in the two amounts in your balance sheet, you can see why that's expense. You're going to subtract out of that the employer contributions to the plan. So at its root, it's a change in OPEB liability minus the employer contribution. But then the Gasb said, in their infinite wisdom, that this number would be too volatile. They thought, first of all, you might care about this number. Most people don't. But if you cared about it, they thought this might be too volatile. And so to take out some of the volatility, they would sort of hold aside some of the changes in the net OPEB liability from year to year and only let them flow into expense over a period of time. And so those amounts that are sort of held out and flow into expense over time are the deferred outflows and inflows of resources. But that's really, if you keep in mind what the root of OPEB expense is, it's a change in that OPEB liability, it'll help your thinking about it. Okay. So what kind of a plan do I have? Hopefully you know this already because we're now into July. But a lot of people have defined contribution plans or are trying to have defined contribution plans, or maybe are hoping they have defined contribution plans. If you want a defined contribution OPEB plan, there's 3 rules you have to follow. And it's a very strict ruling. You have to have an individual account for each member, typically each employee in your plan, and that's going to hold money, okay? You'll put money into those accounts while the employees are active, and you'll put money into the accounts in a way that's defined in your plan. So it might be, $100 a month goes into this account. The accounts can be merged together, but you have to track them separately. And then when a person retires, all they get for OPEB benefits is whatever happens to be in that account at the point they retire. If that's the way, and the account has to have actual investment earnings, okay? So if you give it a guaranteed rate, that doesn't count, actual investment earnings. If you can meet all those 3 rules, you have a defined contribution OPEB plan, and none of the rest of what I'm going to say today applies to you. Okay. Most people don't have defined contribution plans. If you don't have a defined contribution, you're a defined benefit plan, and some of the little things that can make you fall into the wrong category is you do something like guarantee an interest rate on the account balances. I mean, even if you guarantee an interest rate of 0, it probably pushes you into a defined benefit plan. Sick leave conversion plans are always really tricky, but if you have a plan where people accumulate sick leave, they have unused sick leave at retirement, and it turns into benefits. So for every 40 hours of sick leave, you get 6 months of coverage in the OPEB plan. That's the defined benefit OPEB plan. If you cash out the sick leave and you give them money and they can do whatever they want with it, that's not an OPEB benefit. Okay. So then the next question, assuming you decided you have a defined benefit OPEB plan, the big question is, are you funding or not? Is it through a trust that's irrevocable? If not, then you're subject to the special rules for not unfunded plans, and if you are, you have to figure out what kind of a funded plan you have. There's 3 kinds of plans. There's single employer plans, which are all the unfunded plans, but also plans that only have one employer. There are agent multiple employer plans. That's plans where the money is commingled for investment with other plans, but it legally only belongs to you. And then there are cost-sharing plans where the money is commingled for investment, but it actually is allocated among the different employers in the plans. There's not many cost-sharing plans. There's a few of the counties have cost-sharing plans, but generally we don't see it very much for OPEB. The bigger question is whether we have single employer plans or agent multiple employer plans, and CERBT has said that they are an agent multiple employer plan. PARS, I think, is a little bit iffy. They're likely single employer plans, and if you're funding with somebody else, you really need to be talking to your auditors to try to make that decision. The good news is for reporting under Statement 75, if you have either a single employer plan or an agent multiple employer plan, it's the same. So we don't really need to worry too much. Okay. 75 is really, really similar to Gasb 68, and I'm hoping that at this point, after 3 years, everybody in this room is an expert on pension accounting under Gasb 6. No. Okay. I was hoping. But I'm going to assume you know something about pension accounting, even if you're not experts yet. And so we'll talk a little bit about how Statement 75 and what we see in the OPEB world compares to the pension world. So just kind of looking at different categories. If we think about plan funding, if you're in a pension plan, you're probably in CalPERS, you might be in one of the county plans. These things are always funded. You have to fund them. In the OPEB world, it's your decision as the employer whether or not you fund them. Some of the disclosures are a little bit simpler if you're not funding. The discount rate for pension plans is based on the rate of return that the assets are going to earn for pensions, that are the rate of return on investment assets. In the OPEB world, if you're funding and funding well, it's going to be the same thing, whatever rate the assets are going to earn, which is going to be very individual depending on where you put your assets. But if you're not funding so well or you're not funding at all, we're going to use the long-term rate, we're going to use a 20-year municipal bond rate, and you're going to select that rate. Okay. So it's going to depend a lot on not only where you're investing your money if you're investing, which discount rate you choose, and what your funding policy is. So even though you may not have a lot of assets set aside now, do you have a policy and a plan of funding a good amount going forward? So all those things are going to factor into it. There are some sensitivity disclosures. You saw them in the pension world where you'd say what happens if the discount rate goes plus or minus 1%. We have those same things in the OPEB world, except we've added another sensitivity for healthcare trend. The implied subsidy is going to come up a lot today. It doesn't exist in the pension world. It exists in the OPEB world, and it can make the accounting very confusing. Okay. So it's not just a question of we've included it and all your numbers got bigger, it's how to account for it, which keeps creeping into all the numbers. We'll talk about it where it comes in. So the other big difference is sort of in the who does what. In the pension world, particularly if you work with CalPERS, CalPERS did an awful lot of the stuff about pension reporting. And if we kind of go down all the things that are to be done, in the OPEB world, most of those become employer responsibilities. Okay, so if you think about the pension benefits, CalPERS gives you a menu of what pensions you want. Now you only have a choice of sort of pepper or not too much choice left. But in the OPEB world, it's anything you can bargain with your employees. Pretty much, you can do whatever you want, and that also leads to the corollary that every single OPEB plan is different. So the employer designs the plan, negotiates them, and administers them. In terms of the plan assets, if you as the employer, have the choice to fund or not, and you have the total choice of where to fund, or you can even decide you can't make up your mind and fund more than one place. Well, that's fine, your choice. Census data, CalPERS is really in charge of that for pensions, but for OPEB, it's an employer responsibility. If you have benefits from PEMCA, CERBT can help, but what they give you is usually not particularly complete. So again, it's a lot of employer effort to get good census data. The employer is going to select the actuary. The employer is going to do all the reporting in both cases. For auditing, for pensions, CalPERS has hired MGO. They audit a lot of those numbers already. In the OPEB side, your auditor is going to be auditing the census data and most of the numbers and reviewing the actuaries' reports and doing all that sort of stuff. The one thing they're probably hoping they're not doing is that if you're funding, they're hoping that wherever you're funding is going to provide audited assets to them. Okay. We know that PARS does, we know that CRBT do, and I don't know about all the other providers. If you have your own individual trust set up, you definitely want to talk to your auditor about that, about who's going to audit the assets in that trust. Long-term rate of return on plan assets for OPEB, that depends on where you're funding, if you're funding. Even things like selecting the actuarial valuation date and the measurement date is an employer responsibility for OPEB. Sometimes we think the choice is probably pretty obvious, but it's still your choice. You can do what you want. And then we get to a lot of the calculations of the OPEB liabilities and deferred inflows and outflows and stuff like that. And that's what what the actuary, the employer hires for your plan is going to do. They should do those calculations and give you a report that shows all that. It's not coming from a central agency like CalPERS, so they're all going to look different. And then again, in either case, you, the employer, are going to be the one doing the journal entries and preparing the financial statements. Okay, questions so far? Okay, we're good. That was maybe the easy part. What does this look like in reality? Okay, so what I want to do for the next bit is, this is a CCMA white paper that was published to help employers implement Gasb 75, and it had in it a sample footnote. And what I want to do is kind of go through that, because I know that a lot of people start preparing their financial statements by copying out of the white paper, and want to highlight things you should know as you do that. Okay. So the first thing, this is the sample note about the post-employment benefits. The sample in the white paper is a funded plan. It talks a lot about their fiduciary net position. If you are not funding, please don't copy those words. You don't have any assets. One thing that's really helpful is that they put a nice little table of what was the valuation date, what was the measurement date, and what was the measurement period. I think that helps get everybody's heads on the same page as they're reading through your financial statements. Okay. So then we move on to the description notes, the description of the plan. Pretty obviously, you're going to replace this paragraph with whatever your plan looks like. It's going to be different than everybody else's plan, so don't copy. Probably it looks like a lot like the description you already have in your current financial statements when you're reporting under Statement 45. You're going to talk about the eligibility, the benefits you provide. The actuary's report might have a description of the plan that hopefully agrees with what you think the plan is. It doesn't always. The big thing to notice is that this disclosure, this sample plan, is not a plan in PEMCA. If probably half the people, who has OPEB benefits through PEMCA? Not as many as I thought. Okay. If you are thinking about the PEMCA benefits, you would read this description and say, wait a minute, you can't do that, and that's because they're not a PEMCA plan. You do have to talk about the name of the plan, which is you probably need to invent a name for your plan. You have to talk about what type of plan it is, what are the benefits, and who's the administrator. And if it's actually closed to new hires, you have to say that. Okay. This is a really interesting requirement, and this is the error in the slide. It's wrong? It's wrong. Okay. So you guys in this room get to benefit by being here and hearing me say this is not correct. The number of employees is supposed to be reported as of the measurement date. Okay. If it's not significant, if it is significantly different than at the fiscal year end, you're supposed to say something about it later. But it should be as of the measurement date, not the actuarial valuation date. Why is this important? You spent a bunch of time collecting census data and working with your actuary to get a really good count on the valuation date. That may or may not be the measurement date. If it's not the measurement date, so maybe you did a 2016 valuation and the measurement date is 2017, your actuary does not know what the counts are on the measurement date. Sometimes it feels like we spend half of the work of our valuation trying to count the people. So this is not necessarily an easy task. So if you think it's going to be difficult to get the actual numbers, probably again you want to talk to your auditors about how significant they think that is. Well, why is it hard to count people? Well, first of all, a lot of times you have different benefits and not everybody is eligible for the same benefits. So you have to worry about getting a good count of not only people who are receiving benefits, but who could potentially receive benefits, who are your active employees. You want to count all the active employees who are or could potentially receive OPEB benefits. So that means if they're currently waiving active health care, they still count because they could get OPEB benefits when they retire, so you want to count them. If you have a provision that employees hired after a certain date are not going to get an employer subsidy but could still buy into your plan and pay the full premium, they count. But if your plan has said, people hired after a certain date, we're not paying anything and they cannot come into our plans in the future, then you don't count them. I think you probably also don't count, if you have like really temporary people and part-time people who don't get benefits, they would probably not count either. You count, in all this counting, you count units, okay? So what the family units, employee units. So if an employee is covering a spouse and a family, that's one. Even once they're retired, if you have a retiree and a dependent, that's one. Okay, it's not two or three. And then if the retiree dies, you're covering the surviving spouse, it's still one, even though it's a different one than it was before. Okay, so that's how we count people. The category of inactive employees or beneficiaries entitled to but not yet receiving benefits is also kind of difficult. If you're in PEMCA and some other plans will allow people who leave employment, particularly if they retire directly from you, they may choose not to start healthcare benefits right away, even though they're retired. If you're in PEMCA, they have the ability to come back to you at any point in the future and elect into your plan if they retired from you. So there is this category of people who could potentially come back, and those people are really hard to find. If you're in PEMCA, they may be able to help you find those people. If you're not in PEMCA, you probably have no record of them, and you wouldn't know they exist until they show up on your doorstep. But you can try to count them. Okay. Moving on, we have a note about contributions. You're supposed to talk about how you decide, again, if you're funding, how you decide what the contributions are that go into the plan, who has the authority to make that decision, whose authority is it to establish the terms of the plan, and what the contributions were during the period. Okay, contributions meaning benefit payments if you're not funding. We have a note about the net OPEB liability. Here's where you say that if the actuary did the valuation at one date and the measurement date's a different date, that you rolled forward the liability to the measurement date. The statement does not talk about this, but we think that a lot of times in the first year we don't have opening balances, and actuaries are actually rolling things backwards a year to get the opening balance. We think you probably ought to mention that too. Then we have a page that's all about notes that talks about the actuarial assumptions used. And you can kind of see the list they give. They want you to talk about what was the discount rate, what's inflation, what are salary increases, investment return, mortality improvement particular. So this whole list you should be able to find in your actuary's report. You put it in your financial statements. Again, every plan is different. Don't copy from the white paper. One assumption that's not listed in the statement that I think is really, really important is participation assumption. So if you have a plan that pays really good OPEB benefits, probably just about everybody who retires elects to be covered under that plan. So we would assume 100% of the people. If you're providing something like PEMCA minimum, where you pay $125 a month to people, if they pay the rest of the premium, we're going to assume 50% or maybe less people actually collect that benefit when they retire, and that makes a huge impact on the numbers. If I assume 50% of the people take a benefit, my liability is half of what it would be if I assumed 100%. So that's why I personally think that's a really key assumption, and you should say something, but it's kind of up to you. The one thing the Gasb does say you should talk about is cost sharing with retirees. And what they're getting at is a plan that has particularly a cap. Okay, so you're going to pay the retiree premiums, but no more than $300 a month. What they'd like you to say is, in doing the calculations, the actuary assumed that that cap would always be $300 a month, and any additional costs would be borne by the retiree. What happens some places is that there is a cap like $300 a month, and it sits there for a couple of years, and then the plan gets expensive, and then the employer changes it to $400 a month. And then a couple of years later, it changes to $500 a month. And the Gasb is really trying to say, You know, if you have a past practice of not adhering to these cost-sharing provisions, we want to know about it. Okay, so that's what they're getting at there. If you do have that sort of cap thing, they do want you to mention it. Okay. Long-term expected rate of return on plan assets, again, only if you're funding. You need to put this chart in. You probably had a similar chart for pensions that you took from CalPERS. And so here it's going to depend on where you're funding, different for every plan. And what you're going to say is, what's the target asset allocation of the place where I'm putting my plan assets, and what's the long-term expected real rate of return on those asset classes? So you might get this from the place where you're funding, so PARS or CRB, the RBT might tell you this, your actuary might supply this information, you might have an investment manager who would supply it. You're not necessarily going to be able to sit there and multiply each row out and have it add up to the expected return on assets, because the modeling is actually more complicated than that, but it should come out somewhere the same. So if your long-term rate of return is 7% and you actually multiplied out the asset allocation times the return and you got 15%, something's wrong. If you got 2%, something's wrong. It should be somewhere around the long-term rate of return. Okay, but you don't have to show that calculation. The discount rate, you have to again say, here was the discount rate. It's probably going to reference the crossover test. That's the test the actuary uses to see if there's going to be enough money in the plan to fund benefits under the very strict Gasb guidelines. And so they're going to say something about what they assumed for future contributions to the trust. So if it says something like this one does, we assume that the contributions are going to equal the actuarially determined contribution going forward, you should make sure that that's really your funding policy. If your funding policy is to pay half of the actuarially determined contribution, you would get a different answer. Okay, so make sure that that's correct, and whatever the actuary has written in their report about what they did, that's correct. If you're not funding, or if there is a crossover so it's not well enough funded, you'll have to mention the municipal bond rate that you're using. We said that already, cool. Here's the sensitivity slide. So the top is exactly what you had in benefits, in pension benefits, the change due to the 1% change in the discount rate. The bottom one is new, and it talks about the change in the trend rate. The trend rate is the expected future increases in healthcare costs that don't have to do with aging. Okay, long definition, but think about it as healthcare costs. The actuaries generally project that right now that is sort of high, but in the very long run, it has to come down, and it has to be more like inflation, because otherwise there will be nothing in the world except for healthcare. We'll all work in healthcare, and that's really not a reasonable assumption. So those trend rates that the actuaries use tend to have incomprehensible headings on them. They're trying to condense a fairly complicated assumption into as little space as possible. So please try to do a good job of copying it down and writing it down, because it doesn't mean anything to you, but for the other actuaries who read it, it means something to us. Okay, we're getting into the more numerical stuff. So this is the one about the change in the net OPEB liability from the beginning of year to end of year. Again, if you were an agent plan, you had a chart similar to this for pension. If you were a cost-sharing plan, you probably didn't. Okay. It flows things from the beginning to the end of the year. You should be finding this in the actuary's report. If you're not funding and you don't have a trust, it's kind of interesting. You don't take the column for fiduciary net position and write in 0. You just don't have to put those columns in at all. If your actuary is not using a roll forward or roll back, so if they've actually done a valuation at the beginning of the year and the end of the year, you're going to get differences in experience during the year. And that'll be one item on this chart. But if most likely your actuary is using some sort of roll forward for the first valuation, so probably you're going to get 0 for differences in experience. Seriously. Contributions to the trust. There's a line in the sample for employee contributions, and they really do mean active employees. So this is a pretty rare circumstance where you have active employees making contributions towards OPEB. You would report that as an employee contribution. Your retirees who are paying a portion of the premium or co-pays or whatever, that doesn't count. That's not recorded anywhere in this accounting. Benefit payments, here's the first time we're gonna show you that. Benefit payments are going to include the implied subsidy benefit payments, okay? So probably you know by now that when actuaries do the liability for OPEB, we have to include this implied subsidy, which is the value of benefits retirees get that is bigger than the premiums, and that comes from having a blended premium among pre-Medicare retirees and active employees. And so when I'm doing my actuarial evaluation, I add in that liability. So associated with that, there's this sort of concept of implied subsidy benefit payments. You can think of them, if it helps, as imaginary benefit payments that only the actuary knows about. It works just fine if you think about it that way. So how do you know what this number is? The only way you can know is to ask the actuary what were the implied subsidy benefit payments for the year. They should tell you that. And then when you're looking to see how much did I actually pay in benefits, make sure that you add in the implied subsidy. And that implies, actually, the benefit payments goes in 2 columns. Implied subsidy goes in both columns, too. Seems obvious, but the bottom line, the actual trust assets have to be the actual trust assets at your measurement date. And they should be the audited assets. So CERBT is sending out whole reports full of audited assets that are very close to, but not exactly the same as your June 30th statement. So make sure you pick up the audited ones. Hopefully your actuary has, but depending on the timing of when they issued their report, it might not be. Okay, moving on. Question? Yep. Yeah. So minus minus a minus is a plus, is 0. Sorry, it took me a while. Yeah, if you have a -5 minus a -5, it's like -5 plus 5 is 0. It works. She's not convinced, but it works. Okay. This is in the white paper. It has like a whole 2 paragraphs on the period of time that you're recognizing deferrals over. I don't actually think this is a required disclosure. It's really interesting to me as an actuary reading the notes to see what that number is, but I don't, just to make me happy, I don't think you need 2 more paragraphs of this footnote, so I would not put it in. Okay. Deferred outflows and inflows. So remember we said when we were talking about expense that OPEB expense was originally the change in net OPEB liability from beginning to end of year minus the employer contributions, but then they decided that some things should be held out and only recognized over a period of time. Those are your deferred outflows and inflows. The chart you put in the notes is very similar to the one you put in for pensions, and everyone would have had these for pension plans, and the labels are pretty much the same thing. Depending on what you get from your actuary, you may have to be a lot more careful about the dates and how you pick them up out of the actuary's report and put them in your notes. Okay. So these are going to be for the fiscal year ending June 30th of 18. The actuary will have calculated them as of the measurement date, which might be 18 or might be 17 or somewhere in between. But you're going to report them as of the end of the fiscal year. Some of them you're just going to copy down from the actuary's report. The one that might not be in there or might not be in there correctly is the OPEB contribution subsequent to the measurement date. So that's for anybody who's making contributions or benefit payments after a measurement date and before the end of the fiscal year. Probably most people, but not everyone. There's 3 pieces that have to be in that number. One is any payments you made directly to the trust, if there is a trust. One is employer-paid benefits or premiums, so if you're paying the healthcare costs directly and not getting reimbursed from the trust. Okay, so if you put money in the trust and then you pay the benefits and then the trust pays you back, you can't count it twice, you only count it once. And then thirdly, again, the implied subsidy benefit payments that are going to come from the actuary. You need to add those in. So those 3 numbers are going to go into OPEB contributions subsequent to the to the measurement date. They're right up through the end of the fiscal year. So that's something your actuaries are probably asking you right now to kind of add up and tell them what that number is. If you total up the deferred outflows and inflows, except for the contributions after the measurement date, it equals the next page. This is my award-winning, absolutely most useless page in the whole footnote. I challenge anyone to dispute that. So what is this for? You might have wondered. If you have somebody who's modeling your organization and they're trying to model out your future financials and they feel that OPEB expense is really important to your financials and they're trying to figure out what's going to happen to it in the future, they know a lot about your service costs and interest costs and liabilities, and this lets them know how the deferrals will go into expense in the future. So I think that's pretty unlikely that anyone really wants to know that, but if they did, here are the numbers they need. So those are just the flow of the deferred outflows and inflows into expense, and the only thing to be sure is that they add up to what the prior page added up to. Okay. Required supplementary information. This is the same chart we saw before a couple slides back, except stretched out vertically, because over time you're going to put 10 columns of these together. Again, just like pension. This is as of the measurement date, even though it'll say probably as of the fiscal year end, but it's really as of the measurement date. And so when you come down to the bottom, it's going to ask you for covered employee payroll and ask what's the proportion of covered employee payroll. So the payroll you need here is for the year ending on the measurement date. Okay. What kind of pay do you need? Pretty tricky. If you have if you don't have a trust, it's covered employee payroll. If you do have a trust, and you're making contributions to the trust as a dollar amount, most people do it that way, it's covered employee payroll. Covered employee payroll is the total payroll of employees who are kind of the same people you counted when you were counting headcounts, the people who are covered by the plan or who could be covered by the plan. So basically your active employees. And it's what I think of as gross pay. It's base pay, overtime, bonuses, special pays, pretty much everything that would go on a W-2, okay? It's total pay of those people. Not all employers fund their OPEB plans by paying the dollar amount the actuary tells them to. Some people fund it by paying a percent of pay. So if I calculate that you should make a contribution of $500,000 and that's 5% of pay, and you actually make your contribution as 5% of pay, then you do something really different. If that's the case, first of all, covered payroll becomes the base pay that you applied that percentage to. Okay, so whatever that pay is that you applied the contribution percentage to is the pay you report, and it's called covered payroll. And then when you do the next exhibit that talks about what was the actuarially determined contribution, you recalculate the actuarially determined contribution based on payroll. So the easy way to do that, you could actually redo that whole calculation, or you could just say, I followed the rules, I paid the percentage the actuary told me to, so therefore whatever dollar amount I contributed is the amount I was supposed to contribute. And you just put the same number on both lines. Okay, so should I do that again? If you're paying the trust as a percentage of pay, you're going to use that payroll base as your covered payroll, and you're going to change the actuarially determined contribution to be the amount you actually paid. If you're not, if you're just contributing a dollar amount, you put the dollar amount you contributed, and then you put whatever the actuarially determined contribution was next to it, and you use as payroll, total payroll of the covered employees. Okay. That payroll definition is the same for both RSI pages. This RSI page on contributions is for the fiscal year, so you want payroll for the 12 months ending on the fiscal year end, and this page, you need it for the fiscal year ending on the measurement date. Probably neither of those payroll numbers are PERSable pay, so it's probably going to be different payroll than you put in your pension notes. Sorry. Okay. Did I say everything I needed to say here? If you don't have a trust, you don't need to report the actuarially determined contribution. And in fact, you may even have a trust and your actuary may not have calculated an actuarially determined contribution. And if one is not calculated, you don't have to report it. And you don't have to say whether or not you paid it.
On covered payroll, is that on an accrual basis or a cash basis?
I'm not a good person. So the question was, is the covered payroll on an accrual basis or a cash basis? I can't answer that. Is Catherine, do you know? She's looking. Amy? Is it accrual or cash?
Oh, she's walking me to the mic. So it'd be. I'm walking to this mic? What mic am I walking to?
Or you can talk into my
Okay,
ear.
I'll talk into her ear. Think about it as it'd be at the fund level basis, because these contributions are going to be at your fund level contributions. So partial full accrual, because your enterprise funds and your governmental fund basis as well. So just as long as it's reasonable. It doesn't have to be an absolutely perfect number. Does that help? That's the question. What?
She said, as long as it's reasonable. I guess my worry would be, if you did cash basis, aren't there like 5 years you get 52 weeks, and the next year you get 53 weeks, and so you get this kind of funny pattern, but it's not a big deal.
Agreed, as long as it's consistent from year to year. So if your accrual at the end of the year is significant, then it should include it. Does that make sense?
Okay. Good question. The last thing that happens on this page is that underneath the contributions, you have to have a list of the actuarial assumptions that went into determining those contributions. And you may say to yourself, I just did that 2 pages ago. I had this long list of actuarial assumptions. Why is this one different? The reason is they're different. This is describing the assumptions behind the contribution requirement. So your actuary could be using very different assumptions. They're not required to follow the Gasb mandated assumptions to calculate your contribution. Sort of anything that you and your actuary think is reasonable is okay. So they may be very different assumptions. The other thing is that a lot of actuaries calculate the contributions ahead of time. So they might do a 2015 valuation that gives you the contributions for your 17 and 18 fiscal year. So you might be looking at like a valuation from a couple years ago, whereas your total OPEB liability is coming out of a more current valuation. So you do need to put whatever you think are the relevant assumptions from the valuation that calculated the contribution onto this slide. Okay. And again, everybody's plan is going to be different. Don't copy your neighbors. Okay. Sorry. Are we good so far with the notes? So you know what to look out for. I'm going to talk about journal entries. And so I'm going to preface this by saying that I am not an accountant. I've learned a lot over the past few years, but I'm going to probably say some things wrong, so please forgive me in advance. All right, we're going to try. So there are 6 journal entries in the back of the white paper, and really 6 journal entries that you need to do for Gasb Statement 75. And they go into 2 categories. The first 3 are things you need to get started up correctly, and the next 3 are ones that are going to happen every year. Okay, so Where we're going with the startup entries in the first year is trying to get things as of, let's say, July 1st, 2017, the beginning of this year, to where they would have been if you had always been reporting under Statement 75. So the first thing you need to do is erase the accrual you have under Gasb Statement 45. Okay. That's a very different number. It was calculated differently. It was sort of the difference between what you contributed and what you should have contributed. You might have a really big asset there that is now going to go away and turn into a liability. So the first entry, it has X's. It just is reversing that entry that was there before. Okay. The second one restates the net OPEB liability that was there at the beginning, of the first fiscal year. So the net OPEB liability you would have had at July 1st, 2017. Debit net OPEB liability, credit unrestricted net position. This is really weird. The white papers plan is overfunded at the beginning of the year. Probably that does not apply to anyone in this room. I told them that this would confuse people, and they said, too bad. So be really careful when you make this opening entry. Probably yours is going to be backwards. Okay. So the third thing that has to happen, now we've got the net OPEB liability at the beginning of the year established. If we had been reporting under Gasb Statement 75 all along, and so all these entries are assuming that your measurement date is not the end of the fiscal year. You would have had a deferral for the contributions made after the end of the prior measurement date and before the beginning of this fiscal year. So you need to establish that also at the beginning of time. And in this case, it was $279,000. Okay. So these three entries together get you set up where you would have been if you were always under Statement 75. The next three, now we've moved from July 1st, 2017 to June 30th, 2018. We have to do three things. The first thing we have to do, this is listed as journal entry number 5, is get rid of the deferral for contributions after the end of after the measurement date before the fiscal year, because now they've actually happened during the measurement period. So you're going to debit the net OPEB liability, bring them in and take them against the net OPEB liability, and take them out of deferred outflows. So just sort of reversing what you just did. Okay. Then along with that, you need to set up the new deferral for contributions after the measurement date. Sort of implicit in this is that as you've been making contributions, you've been debiting them to OPEB expense. I don't know that that's always the case as much as it is for pensions, particularly because contributions, again, include contributions to a trust, benefit payments, and your implied subsidy benefit payments. So this entry is taking them out of OPEB expense where they probably got charged to and moving them to deferred outflows. Okay. The last journal entry is where everything happens. This is kind of confusing. I'm going to go through it in pieces. The first thing that's happening is down at the bottom. Can I make this work? Okay. So this is calculating this number that goes up here. And think about what's happening. It's looking at the change in the net OPEB liability. Here's the net OPEB liability at the beginning of the year. You can see that it was negative. Here it is at the end of the year. Here's a contribution during the year. So it's a change in net OPEB liability minus a contribution during the year. Way back on slide 10, I told you that that was the basis of OPEB expense. Okay. So that's why this calculation is here. It's looking at the change in the net OPEB liability for the year. It goes up there. So remember, net OPEB expense is a change in the net OPEB liability for the year minus employer contribution during the year, minus all the deferred inflows and outflows that we're not recognizing in expense. So the next thing you need are all the balances of your deferrals that happened during the year. So in this case, there was a deferral for a change in assumptions and a deferral for the difference, the asset gain or losses. So those go here. And then, so magically you add them up. What does it take to balance? And that amount that it takes to balance, the plug number is your OPEB expense. If you hopefully, in your actuary's report, They're going to tell you these things, and they're going to tell you OPEB expense. And so if you enter all the numbers right, it should balance. And then you know you did everything okay, you make those entries, you're done. First year, it's easier because all the deferred outflows and inflows, all you need are their balances. In the second year, you need the change in the deferred outflows and inflows, so it's a little bit more tricky. Okay, you ready to try one? I think that in the booklet, let me look. Yeah. Probably you have a separate thing that looks like this, stapled together on its own. So what we're going to do is we're going to go hunting and see if we can find the numbers we need. Okay? So this is a sample actuarial report. It's not really one of mine. I tried to make it a little bit confusing, but not too confusing. Okay, here we go. So the first thing we're going to do is try for the first journal entry that reverses what you had on your books under Gasb Statement 45. So the question is, can anyone find it in the actuary's report? Nobody shouted out the answer at me. The answer is most likely it's not going to be there. Okay. It should be on your balance sheet. You should know that number. It's not that hard to find. Most actuaries are not going to go look for it and put it in their report for you. So you know what it is. You don't need them to tell you. Okay, that was an easy one. Okay. So now let's go look for the net OPEB liability at the beginning of the year that you're going to use to establish your Statement 75 accounting. So if you know what the number is, tell me. Do you want 10 more seconds to look, or should we just say what the answer is? Wait, I heard a number. $410, $682. $410, $682. So where did we find that? Page 7, yes. There was a page that looked like this. It looked like a really good candidate because it talked about things like unfunded liability. But it wasn't the right, it's not right. How do I know it's not right? Well, it doesn't say total OPEB liability. It says some other words that are kind of good, like actuarial accrued liability and unfunded liability. And it doesn't talk about measurement dates or fiscal year ends. So I would use this if I couldn't find anything else. But if you keep looking in the report, you'll find one that looks like this. It actually says total OPEB liability and net OPEB liability. So you know that that's on the basis that it needs to be for Statement 75. So we're going to take that number, the 410. Okay. So the third thing we need is the contributions made after the prior measurement date, so after June 30th of 16 and before July 1st of 2017. Those will be somewhere in the report. So the first guess was page 2 or page 3? But the answer is no. Sorry. How do I know it's not right? Well, when I look at this, the first thing I notice is that there's no benefit payments listed on this. Okay? This is actually a reconciliation of the trust itself and only things that are going in and out of the trust. So this employer is paying the benefits directly and then putting some money separately into the trust. But what we need is contributions under Statement 75 is the whole thing, the benefit payments plus the trust contributions. So this number isn't going to work. This is a good candidate page again because it's using the magic words net OPEB liability on the top, so I like it. It's Gasb 75 words. It's showing, it actually has a column labeled fiduciary net position. I like that because it's an accounting word. So if they have the accounting names for things, it's sort of a hint that maybe that's a number you want for your 75 reporting. And it shows the employer contribution right there of 21,902. And it shows benefit payments. And I think if I actually added the benefit payments to the contribution on the other page, I would get the 21,902 or very close to it. Okay, so we want the 21,902. We're going to take that number, we're going to put it in this journal entry. Okay, so now we have everything set up as of the beginning of the year, exactly where we want to start the Statement 75 accounting. We're done with that. Now we move to the end of the year and we make the actual entries that happen during the year and every year later. And so the first thing we'll do, we're doing them in a different order, I'm really sorry, is to take the contributions that are made after the current measurement date, so after June 30th of 17, before June 30th of 2018, and move them into deferred outflows. So where would you find that number? I'll tell you this is a trick question. No, we're talking, sorry, we're a year later, because I did these in the actual white paper order. So we're looking for contributions between 17 and 18. So I'm not going to make you look too long, but the first question I'll ask you is, what's the date on the cover of the actuary's report? The actual date it was issued. April of 2018. So probably it does not have it in actual contributions through June 30th. Okay. The only way it's going to get the actual number is if they come back to you after the end of the year and say what were the contributions, and then they can incorporate it. But if the work has been done before, it's not going to be there. Okay. There may be, if you want to use an estimate or a placeholder, there is actually a number in the report. There's a chart like this. And this is what's telling the employer what the employer ought to contribute. So you can see that number is the number that ought to be paid for 17, 18. You could use that number. Personally, I don't like to do that because I always forget that was just a placeholder and I never change it to the real number. I'm happier leaving it with a star or something. But if you wanted to know about what you were looking for, you could find that in this report. But the actual number won't be there because it's published before that number was known. Okay, so you could put it there or call it estimate. Okay, so now we get to the other one. We want to take what was the deferred outflow at the beginning of the year, apply it against net OPEB liability, and get it out of the deferred outflows. Where do we find that number? Yes, that's the number we found before. It's the 21,902. Okay. The last one with all the numbers in it. So this is a journal entry that really records pension expense and the change in the net OPEB liability for the year. And we need to find a lot of numbers for this. We need to find the balance of all the deferred outflows and inflows. We need to find OPEB expense. And we need to find the beginning and ending net OPEB liability. It's really sort of three categories of things you need to go looking for. See if we can find them. I heard a page number. Page 11's a good page. Try to see what order I have. Start with the deferred outflows and inflows of resources. This is page 10. Hopefully your actuarial report has a chart like this. It says these are the balances of the deferred outflows and inflows of resources at the measurement date. So you can pick up numbers you need off of this one. Okay. Those two numbers. And they're going to be the deferrals. Okay. I got asked last time a really good question that I don't have a slide for, which is, if you look on page 11, which is the full reconciliation, there are some rows that say differences in actuarial assumptions and differences in experience. Why are we not taking those numbers? The answer is that those are the full change that happened for those causes. One piece of that is actually recognized in expense, and the amount that shows on the deferral chart is what's deferred, so only a portion of it's deferred. So that's why you want to go to this chart and actually pull up the deferrals. Okay. Did anyone find OPEB expense? Yes? So we have very handily labeled OPEB expense on page 9. That's the number we need there. Some of the actuarial reports will be calculating OPEB expense the way actuaries calculate it, which is by looking at all these components, putting a number on each row, and adding it up into OPEB expense. Don't worry about it, that's fine. And it should be labeled OPEB expense, and so you know you can use it because it's an accounting term. And if it should work just fine. But this is how actuaries think about it, and they're going to report it this way rather than as sort of a plug item the way the accountants think about it. Okay. And then the last thing we needed was the net OPEB liability at the beginning and end of the year. And you'll see those here. We saw we had the 410 already in the opening journal entry, and the contributions we had already. So we can go and write all those numbers into this page. So we put the deferred outflows and inflows of resources into the first two entries, and we had to change. They were inflows, so they had to change from outflows to inflows, the way the white paper has them. We put the OPEB expense, the 21,717 there. We put in here the beginning and ending balance and the contribution during the period. Be really careful about your signs. So if I go and write the 732 up there, it works, it balances. My journal entry balances, everything is good. You look surprised that it worked. It's not that hard. I think the hardest part of it is, particularly when you have accounting numbers and funding numbers in the same report, being really careful that you find the numbers that relate to accounting and not to funding. Okay, I think that is my last slide.